Good evening, everyone. A warm welcome to all of you at today's session. Myself, Prachinegi from CA Sansaar. Today is the sixth day of ongoing 14 days webinar MahaKumbh, which is started from 16 November 7 p.m. onwards live on YouTube. Today's session will be taken by CA Yash Dhadda ji on the topic Burning Issues in GST. Yash is a fellow member of the Institute of Chartered Accountant of India. He is associated with Messrs. Dhadda and Company as partner. He is having working experience of over 11 years in the fields of indirect taxes with the concentration only on GST, service tax, and excise matters. He is currently engaged in handling litigation along with advising clients, structuring transactions, and conducting due diligence in given fields of taxation. He has written handbooks on principles of classification for goods and services under GST and also on casual taxable person for IDTC of ICAI. He has also actively contributed as core member of the team which has drafted technical guide on GST audits issued by ICAI. As his passion, he is also engaged in grooming young professionals of CA, CS, and MBA on topic of soft skills and professional life management. Yashji is a commerce graduate from Commerce College, Rajasthan University, Jaipur, and certification holder of indirect tax course conducted by ICI. Now I request Yashji to please start his deliberation. Over to you, sir.
Thank you so much, Prachi ji. My screen is visible?
Yes, sir.
Okay. Thank you so much, Prachi ji. Good evening to all the members of CA Sansaar family. In absentia, Vivek ji and the moderator, Prachi ji. Thank you, first of all, so much for giving me this opportunity to be part of this 14 days MahaKumbh webinar series in various different matters. I was able to see some of the topics which were part of this MahaKumbh series, and I realized that variety of topics have been chosen in this. And that's how Vivek ji has always worked. He has always been very compassionate about imparting knowledge and disseminating knowledge amongst the members, and specifically the CA Sansaar family members. So congratulations to him. Because we have a very specific time duration of one and a half hours, 15 minutes. I was thinking of choosing very specific issues in context of GST. Earlier I thought probably we can pick one topic, but then I realized that there are some of those issues which keep on coming to us regularly in our day-to-day professional life. Some of the issues coming from various high court judgments which have been given by various high courts across India, recent judgment of Honorable Supreme Court in case of Bharti Airtel, and then some of the issues which arises from various audits and scrutinies which are taking place across India in context of GST matters. And I thought that we'll combine all of them together, and I'll try to present those issues and at the same time try to give my views and possible tax management we can look at and best practices we can look at, so that we can advise our clients sincerely and properly in this regard. Now, before I go forward, generally when I start with, I take some number or some code. Probably in the earlier forums of CS Answer, I might have shown this table, but this table still makes a lot of relevance today. That is basically the number of matters which were pending before the Honorable High Court or the Supreme Court of India up till September 2020, that is last year. And if you total these number of matters on various issues, which you can see on your screen, the total number of matters were approximately 1500, which were pending on up till September 2020. And if you calculate from 1st July 2017 up till September 2020, you will realize that number of days were lesser as compared to the total number of matters which were pending across the High Court and the Supreme Court. And then that makes us realize and understand that GST, though being called as a law or basically a mother of indirect taxes, aim towards simplification, but at the same time it has been challenged on various forums in respect of various issues. Now, once we talk about challenge, as a practitioner, maybe as a chartered accountant or a cost accountant or as a lawyer or any other professional, it is being told to all of us that GST has lot of scope for litigation, or at least now this is that act where a lot of things would be put before the adjudicating authority, proper officer. They would pass an order, and then one might have to go into appeal and decide and see where the matter actually ends up, or what is the fate of it. Now, in this whole process, one thing which is very important to understand is when somebody is filing an appeal, maybe before the first appellate authority, or whenever we'll have the second appellate authority, that is GST tribunal. When we say we have to file an appeal, that means along with filing of appeal, we have to take care of one more thing, that is called as pre-deposit. And in context of pre-deposit, recently we have a judgment from the Honorable Odisha High Court, and this judgment, though it is negative in terms of that it is not favoring the assessee, but it kind of brings a definitive clarity amongst all the taxpayers and people who are conversant with GST, and they should be aware about this, wherein an appeal was filed before the first appellate authority by the appellant. And when the appeal was filed, when they were required to pay the pre-deposit, that was 10% of the disputed tax, they paid that tax by using their electronic credit ledger. Now, when the appeal was filed online, and it went before the first appellate authority, the first appellate authority did not entertain the appeal by saying that because it has been paid using the electronic credit ledger, which is not allowed in terms of provision of section 49, which talks about how the credit available in electronic credit ledger can be used, and hence that is why the appeal would not be entertained. The SSC went to the High Court. They filed a writ in the High Court by saying that the appeal which was rejected by the first appellate authority was incorrect. It should not have been. It should not have been rejected. And if pre-deposit is paid through that 10% pre-deposit is paid through electronic credit ledger, then that is correct, and that is the valid medium of doing so. The Honorable Odisha High Court went through the various provisions of the Act, and finally they reached to the conclusion that the pre-deposit which is required to be paid is basically not the output tax as defined under Section 2, Clause 82. Now, once it is not an output tax, the electronic, now whatever amount is available in the electronic credit ledger, it can only be used for the payment of output tax as mentioned in Section 49. Because this pre-deposit is not an output tax, hence that is why anybody who is filing an appeal and depositing this pre-deposit, that needs to be mandatorily done from electronic cash ledger but not credit ledger. Now, all those people who come from a VAT background, basically, who are practicing in VAT earlier, probably they were well versed or well conversant with this concept, as I am being told, though I was not practicing in VAT. But I am being told that in case of in the VAT regime, whenever the appeal was required to be filed, whatever pre-deposit was required to be done, that was required to be done in cash only. However, that was not the case in case of service tax and central excise, where the mandatory pre-deposit or 7.5% or additional 2.5%, as it was there applicable at that point of time, it could have been paid using the Senvat credit which was available. Now, that philosophy would not work under GST. The manner in which the provisions are written, all of us have to change. All of us have to understand that if somebody is going into appeal further and litigating the matter, he has to block 10% of the amount which is available in the cash ledger. Precisely, he has to actually deposit 10% amount from his bank account, and then only he'll be able to actually contest the matter. Further, whenever there is going to be a tribunal and somebody wants to actually file an appeal in the tribunal, it requires additional 20%. Mind you, friends, the pre-deposit in case of tribunal, whenever it is going to be functional, would not be only additional 10%, but it is going to be additional 20%. And that additional 20% will also be from the cash ledger. This is going to impact a lot of those people who will have a lot of balance in their electronic credit ledger, but they will not be able to use it for filing the appeal, and they will have to mandatorily actually go into appeal by using this amount from the cash ledger. I have taken 5 minutes in basically explaining this very basic concept, but this has a huge impact the manner in which one looks at the litigation. So tomorrow, when assessee would actually go into litigation, and some consultant advises him that you have a fair chance to actually contest the matter, first thing he will ask is whether I have to block my 10% amount. The answer will be yes, he will have to block that. For how long that amount will be blocked? Generally the average life is between 3 months to 1.5 year. And in that case, for one and a half year that amount is blocked. If tomorrow that matter has to go further, additional 20% needs to be blocked. And I think this is going to change the horizon towards the litigation, where people are certain or understand that the probability to fight to win the matter is more than approximately 50%. And for all those people, that 10% or 20% amount is substantial, they would actually only consider filing an appeal before the first or the second appellate authority. Now, with this, I jump to second issue, and that second issue, though it looks like a very procedural thing, it looks like it is something which is related to technology. This is not something which you and me have to look into on day-to-day basis, but this concept of e-invoicing coupled with HSN, to my understanding, it is going to have huge repercussions or ramifications in the times to come. And why am I saying this is, before I go into the issue in this, or basically how government is able to accumulate lot of data about a specific assessee, and why this warehouse of data is going to be one step ahead from us, it is important to quickly brush up what is basically this concept. So this concept is in respect of certain taxpayers who have a turnover of more than 50 crore rupees in any of the preceding years, ever since the GST has been made applicable. Then in that case, the documents which you see on your left hand side of the screen, that is invoice, be it a export invoice, domestic invoice, or a credit note or a debit note, all these GST documents now they need to compulsorily have an IRN, and that IRN should also be along with a QR code. Basically, the details of invoice needs to be punched on one of the government website called as E-Invoicing website. Come to left right hand side, all these documents which we prepare under GST, for them e-invoicing would not be applicable, meaning thereby the way they were being prepared earlier, one may continue to prepare them in the current regime also, even if one has a turnover of more than 50 crore rupees, and they need not actually have an IRN over it. So this is one change which has taken place. Now what is the ramification of it? First of all, the good part. What is the good part of it? The good part of it, which probably a lot of people who have a reasonably decent size of turnover, who actually want to go into paperless working, and who want to ensure that the automation process is there properly, for them it is going to be helpful. Because if, let's say, I am supplying goods and I am required to actually have my tax invoice carrying an IRN, then in that case, law allows me that I can prepare an e-invoice, and I need not give the physical copy of it to the transporter. Also, we already have rule in place which says that in case you have generated e-way bill, you need not give the physical copy of the e-way bill to the transporter, meaning thereby a transporter carrying goods of a person, that person who is required to prepare an e-invoice, and also e-way bill has been prepared by him, transporter need not carry the physical e-invoice, transporter need not carry the physical e-way bill. He may only be required to carry his consignment note or bilty, whatever the case may be, and he should have that e-invoice maybe in some soft copy available with him, or in the electronic form, or in case he can have the number, then the same can be made available to the flying squad or any other authority who may intercept the vehicle in between. So this saves a lot of time, this saves a lot of paper, this saves a lot of administrative burden which one may have to actually give the physical invoice and physical e-way bill to the transporter. So that's the good part of having an e-invoice. That's an administrative convenience giving to the people who are dealing with this. Come to the second part of it, that is the other side of it which is hidden, the other side of it which is not known, or probably we know it but we kind of actually can't see it in front of our eyes, and that is why we kind of neglect it. So once you look at the whole system, the system works like this, that today also one has its own company, they have their own accounting system. Earlier, that accounting system was generating an invoice, and then on the basis of it, they were filing a return. Now the concept changes. before doing all of that in the returns, they have one more portal in place which is called as an e-invoicing portal, where the invoice details are locked, or debit note details are locked, or credit note details are locked. And once they are locked, those details actually get auto populated in the GST returns. And if one wants to actually get them changed, they may change it manually. In case they don't want to change manually, they may decide not to do so, and they may carry the auto populated data. That is from the supplier side. From the recipient side, it is much easier in terms of that data comes in GSTR 2A, and then whatever matching of ITC they have to do, they would continue doing it. So one thing which we see apparently is only one thing, that before my accounting software and my GST portal, I have one more portal to deal with. That is the e-invoicing portal, and we have lot of companies who are working in this automation thing. So we need not worry actually how are they going to do all of this. Now, what happens if this compliance is not done? I am still not on the point what basically government is able to find out, which we can't see. But let's look at the apparent things which we have in hand. Now, as a supplier, if I am required to do the compliance of e-invoicing and I'm not doing that, then in that case, that invoice which I'm giving to my recipient becomes an incorrect invoice. It's not an invoice which is proper in accordance with the CGST rules. Once that invoice is not proper, I am becoming party to the case under section 122, where penalty proceedings can be initiated against me, where I'm making an invoice but I'm not making a proper where I'm making a supply but I'm not making a proper invoice from it. And thus department can actually levy penalty upon me under section 122, because any which way I'm going to pay the tax, so penalty can be up to 10,000 rupees. Department may actually go into 125 section also, and they can tell me that they want to levy a general penalty of 25,000 rupees under CGST and 25,000 rupees under SGST. Either of the case, department has to pick one section under 122 or 125. Probably 122 is a section which looks more likely, where they would be able to actually sustain the penalty in case they ask for this. That is on the supplier side. One more implication on the supplier side: if I am required to actually prepare an e-invoice, I don't do that. And tomorrow, if any vehicle is carrying goods related to me, and I have given a document to my transporter which is not an IRN enabled invoice, or normal tax invoice which is not an e-invoice format, then in that case, that invoice under which the movement is taking place is not a proper document, and it becomes a case where the vehicle can be intercepted under section 129, and whatever penalty is applicable for interception of non-compliance of e-way bill provisions, because the underlying document on which the e-way bill is prepared is not proper, they may intercept my vehicle and levy penalty under 129. Now, that is on the supplier side. What happens on the recipient side? The consequences on the recipient side are even more grave. And I think that is something which all of us should actually take care of. On the recipient side, the non-compliance of e-invoicing by the supplier, the consequences are grave. That is, if let's say I am the recipient, my turnover is less than 50 crore rupees, but I am dealing with a supplier who has a turnover of more than 50 crore rupees. He is required to actually comply with e-invoicing provisions. He does not do so. Then in that case, the invoice which is giving to me is not a proper invoice on which I can claim input tax credit. And thus, if I am claiming an input tax credit, it is in violation of provision of section 16(2), read with rule 36. And tomorrow, during the course of audit or verification or otherwise, my input tax credit officer can ask me to reverse it, because I have taken a credit on a document which is called as tax invoice, but it is not it has not been issued in the manner in which it was required to have been issued. So as a recipient, if I have to ensure that my input tax credit is safeguarded, it remains intact, I have to keep a check on my supplier, whether my supplier is required to follow the e-invoicing provisions, and if he is required to do so, whether he is following that or not. Now, how am I going to find that? For that, NIC does a lot of work. Every fortnightly, they issue a list of all those taxpayers who are actually required to comply with the e-invoicing provisions. They compile the list in every 15 days. They make it available to the public. If one may download that, one may see to it whether the name of their supplier is there in the list or not, and accordingly they can communicate to the supplier. What happens if supplier does not issues the invoice in that particular format? I tell my supplier that you have to do it, but the time limit has crossed, and that's a problem which probably would going to arise in the times to come. If, let's say, for financial year 21-22, my supplier was required to raise an e-invoice, he does not do so. I tell him after the end of 22 that you raised an invoice in the month of November 2021 to me. It should have an IRN. It does not have an IRN. It is there in my GSTR 2A. I have made the payment to you. You have filed your return. Everything else is all right. But I can't see that, but it does not carry the IRN. The supplier realizes this and supplier actually issues the IRN in the month of October 2022. Whether that would be proper input tax credit, well, according to me, it is going to be matter of litigation. One may argue about it, but it will go to litigation. Once it goes to litigation, that means you will have to shell out your 10% from the cash ledger to ensure that you are able to contest the liability of your that liability which department wants to cast on you when your credit is not proper. Now, having said that, when you come to this, come to the second part of it, of this e-invoicing, which is very interesting and probably hidden. That is HSN codes. So you realize that in October 2020, government changed this concept, and where they said that now anybody who has a turnover of less than 5 crore rupees, he should have an HSN code mentioned in his tax invoice up to 4 digits. And anybody who has a turnover of more than 5 crore rupees, he should have an HSN code up to 6 digit mentioned on the invoice or the tax invoice. Now, when we look at the rate schedule, at least in specifically in case of goods, we realize 95% of the rates which we have, either 5, 12, 18, or 28, or any other rate, there the HSN codes are written only up to 4 digits. Now, when the notification 78 tells me that I need to have 6 digit HSN code on my invoice, that means notification is telling me that at least in respect of goods, I should go to the customs tariff, look at the customs tariff, find out the 6 digit HSN code, and put that in on my invoice. That is also okay. I will do that exercise because I have to pay the tax. Now, let's say I am the supplier, you are the recipient. I am required to raise an invoice with IRN. Once I do that in IRN, that means I am punching your details, I am punching the HSN code, I am punching the description of the goods, and all of those details are getting punched in the system of the government. Now, when all those details are getting punched in the system of the government, then in that case, those details when they come back to you as a recipient, you don't see that. You don't see those details in your GSTR 2A. You only see the details which are punched in GSTR 1. Many of us do not maintain our accounting records on the basis of what actually we see in the HSN code which has been issued by the supplier, but rather we see the details on the basis of what details are otherwise available to me on the basis of expense head. So what I'm trying to say is, let's say I am actually getting details of some inputs in my books of account. Those inputs which I would record in my books of account would be on the basis of my accounting heads. It will be on the basis of the details which I am able to see in my books of in my stock ledger. But government is able to see that on the basis of all this e-invoicing and other things, on the basis of what HSN my supplier has punched in his GST returns, or rather in the e-invoicing format. So this is going to be quite important. This is going to be quite challenging. This is going to be something which government is building the warehouse of data, and that is why the suppliers which are punching the HSN details are going to be very essential and very important as a recipient, which we should take care of. So this is one concept. It is futuristic in nature, but I understand it is going to be it is going to have a lot of information value for the government, where government will be one step ahead from us. Now come to the third issue. Issue of credit notes and debit notes looks like a very simple story. It is a simple story, but this story has lot of hidden things inside it, which now government is able to find out now. What are those things? So today when we issue a credit note wherever I want to reduce my output tax liability, I simply issue a credit note under section 34. I show that in my GSTR 3B and I show that in my GSTR 1. Now, what is the second part of it? Section 34 tells me that when I am issuing a credit note, it is important that the incidence of that tax I have not passed on to my recipient. When I am issuing a credit note in respect of discount, section 15 tells me that the input tax credit has been reversed by the recipient. So mind you friends, there are two things to understand. Credit note issued under section 34, it tells me that recipient should have reversed, the incidence of tax should not have been passed to the recipient. When you basically issue a credit note in respect of a discount, post supply discount, section 15 tells me that according to section 15, the input tax credit should have been reversed by the recipient. Now let's look at last 3 years and let's try to find out how are you going to establish that as a supplier that the input tax credit has been reversed by the recipient. And the answer to that basically comes from only when you take a manual confirmation from your recipient. There is no provision under the GST law which actually, or rather there is no mechanism under the GST law which enables today as a supplier to me where I can find out from the GST portal whether my recipient has reversed the input tax credit or not. But there is a specific provision in the law, and because of the specific provision in the law, the compliance needs to be done. Because the compliance needs to be done today, the audit officers across India are asking for this confirmation, and that is why this becomes quite essential. That is why this becomes quite important. Just 1 minute. Okay. Yeah, that is why this becomes quite essential and important that we ensure that at the year end we keep the records available with us where we take necessary confirmation from all our recipients to whom we have issued the credit notes that they have reversed the input tax credit wherever the credit notes were issued in respect of discount, and we improve from our books of account that the incidence of tax has not been passed to them when credit notes are issued beyond or for a reason other than for the discount. Come to the debit notes. Where debit notes, we have a positive side where there has been amendment in the law under section 16 subsection 4, and that amendment has been made applicable from 1st of January 2021, where today now I can claim input tax credit in respect of debit notes which is on the basis of the year in which the debit note was issued, but not on the basis of when the original invoice was issued. Now how is this helpful? And this is going to be helpful in all those cases where we have classification disputes. Like for example, we see today, or in fact last night only, a lot of changes were made in respect of textile sector, footwear, and for all the works contractor who are providing services in respect of government entities or governmental authorities and their subcontractors. Now, these are going to be rate changes applicable from 1st of January 2022. It's a welcome change which government has done, that approximately 40 days time has been given for all the industry players to understand the impact and to align the prices. Let's say tomorrow somebody is not able to follow these changes and they issue the invoices on the older rates or at the lower rates only. And tomorrow they realize it during the course of assessments and otherwise that they have short paid the tax. Now, if the departmental officer says that he is ready to waive off that suppression clause against me, he says he has no problem if the debit note is issued to the recipient, then this provision helps a lot of those people if they are in a position to actually give these debit notes to the recipient. Tell the recipient that you can claim the input tax credit even after 2 3 years, subject to that department has not raised a case against me on the basis of suppression. So in all those cases where there is a bona fide error, in all those cases, in fact, for the previous periods also where department today realizes that I have short charge tax or the rate of tax was incorrect or valuation was incorrect, this debit note concept is going to help. So you realize there is a vast difference in which these credit notes and debit notes needs to be understood and well taken care of under GST. Come to next concept. Again, very interesting thing, something which we do on daily basis, but at times we ignore it. that is self-assessed tax. And I'm sure all of us are aware about this judgment of MP High Court, which was there in 2020 in respect of Kabir Realty Private Limited. In fact, I remember in one of the earlier videos of CA Sansaar only, I discussed this judgment of Kabir Reality, where the law specifically says that in case of self-assessed tax, department did not give any show cause notice to the person who is required to pay that self-assessed tax, and direct recovery of that tax can be done. Now, the point is, what is self-assessed tax, or how can a self-assessed tax be short paid? Regarding that, MP High Court has given a judgment and a verdict by saying that if there is a difference in your GSTR 3B and GSTR 1, and if the tax in GSTR 1 is higher than the tax which is there in your GSTR 3B, then in that case, what you see in your GSTR 1, the higher tax, can be treated as a self-assessed tax, because you only show that in your GSTR 1, which may not be a return. It is still a statement, but it is a statement supporting your return under Section 39, that is GSTR 3B, and hence direct recovery of same can be done. Meaning thereby, wherever there is a difference in your GSTR 1 and 3B, it is an alarming sign. There has been amendment in the rules. When there is a difference for more than 2 months, your registration can be suspended. Now there has been one more amendment in the rules where if you file your GSTR 3B and you don't file your GSTR 1, then subsequently you would not be able to file your GSTR 3B also. So all these things tell you that now whatever tax liability you're reporting in your 1 and 3B, it should match. If it is not matching, then in the light of this MP High Court judgment, officer can tomorrow give a can actually directly recover it. But come to the concept of interest. That is, I think there has been a difference in understanding and difference in the practice which we have been following. One view is wherever somebody is paying a delayed tax, he should also pay the interest accordingly, whatever is applicable under Section 50. The another view is there is no interest on interest under GST. So why do you want to pay interest today? Pay the delayed tax, wait for it. Tomorrow department will issue a notice to you. If tomorrow department issues a notice, whatever interest you're going to pay today, or whatever interest you're going to pay after 6 months or after 1 year, that interest amount will remain fixed if you have already paid the tax. Now, in this context, we have a judgment from Gujarat High Court where a department actually issued a show cause notice for recovery of interest under Section 73 or 74. The petitioner went to the High Court and the question was raised that whether there is a provision under 73 or 74 for issuance of a notice for interest. Because under 73 and 74, one may issue a notice only for the recovery of tax and along with the tax applicable interest and penalty. High Court read through the provisions. They came to a conclusion that yes, only for the interest, notice cannot be issued under Section 73 and 74. However, High Court went a step ahead. High Court said, but wherever there is a tax which has been already paid, and if it is a self-assessed tax, that is a tax which has been shown in the returns, then in that case, when you read the provision of Section 79, it says a direct recovery can be done of it, and that means DRC 07, to which we call as an order, that order becomes a notice for recovery. And then High Court said that though there is no the notice for interest recovery cannot be done under Section 73, 74. Clearly under Section 50, there is no provision for issuance of an interest. Section 50 is basically for recovery of interest. But in case of self-assessed tax, there is no restriction on the department to actually issue a show cause notice first, and they can directly recover that amount by issuing DRC 07, which is though technically in order, but also a notice for recovery. So things to understand from this, when you read these two judgments together, difference in your GSTR 1 and GSTR 3B, it is alarming. One should take care of it. One should inform the department in advance if in case there is difference, so that your answer is recorded there well in advance, so that you are saved yourself from any a surprise action from the department. And wherever there is a self-assessed tax short paid, don't wait for the notice from the department. Go forward, pay that interest due motive from your side, so that again tomorrow you don't see any surprise action from the department side. However, come to the interest on the ITC side. Again, I think on this part we have some respite. which came from the last GST Council meeting, that is 45th GST Council meeting, where one major issue was actually put forward before the council. Council deliberated upon it, and finally in the press release they pointed this out quite clearly, that as of now under section 50 subsection 3 it needs a retrospective amendment. And when the council has admitted that it needs a retrospective amendment, that means today the section 50 subsection 3 it has some flaws. And what is that flaw? So we see notices where the notice says you have wrongly claimed any input tax credit, pay interest at the rate of 24%. And lot of people who read law, they are able to identify that 50 subsection 3 is not worded like that accordingly today. Council has agreed to it. They've said that they have recommended that Sec 50 subsection 3 needs a retrospective amendment, and the words needs to change from input tax credit availed and utilized. So if any input tax credit has been wrongly availed and utilized, not or utilized but and utilized, then to that extent interest would be payable, and interest would be payable at the rate of 18%. It does not talks about paying at the rate of 24%, but it is going to be payable at the rate of 18%. Now, mind you, friends, this is not applicable today. It is going to be applicable only when there is going to be retrospective amendment in the law that gets notified, it gets implemented. We see some of the provisions of Finance Act 2021 which are still not being implemented today. So this probably would come in the next year's budget, and its implementation would probably take some time, because the way the design of the GST is today, it requires that it has to be passed by the state legislative assemblies also, and that takes a lot of time. But I think this press release of 45th GST Council meeting, all of us should keep it handy. Wherever you see a notice for wrong availment of input tax credit, you should give it to the officer, tell him that that is the intent of the law, that is how the law is going to change. So it makes no sense to actually issue a notice today unnecessary, make an order out of it, ask the assessee to go into appeal, and then tomorrow get a retrospective amendment and claim a refund of it. Maybe the officer who would understand this concept would be able to actually appreciate this. Let's come to the interesting judgment given by the Honorable Supreme Court in case of Bharti Airtel. It was a very celebrated judgment, firstly given by the Delhi High Court in case of a writ petition filed by Bharti Airtel. This judgment came in 2020, where the issue was in respect of 2017, ever since GST had started. And there, because at the initial phase all of us knew that GSTR 1, GSTR 2, GSTR 3 will come, but that they did not come eventually in the manner in which they had to come. Lot of people who were gearing up for it, one of them being also Bharti Airtel. So they were hoping that whatever input tax credit they are going to take post implementation of GST, that will appear and they will put that in GSTR 2, because GSTR 2A, which was a predecessor, or which was basically supposed to auto populate the details which supplier had given, that did not come in the initial period when GST came in. So that is why Bharti took a plea that because GSTR 2A was not there, and the ITC which did not appear in GSTR 2A, they did not put that in their GSTR 3B, and because they did not put that, they had to pay the tax in cash. Later on, they took that credit, which was approximately some 930 CR, subsequently in their GSTR 3B. But for that period in which they could have otherwise taken the credit, but GSTR 2A was not there, hence they had to actually pay the tax out of their cash ledger. Then they went to the Delhi High Court and told the Delhi High Court that we have this circular 26/26/2017, which came in December 17. It had a specific para, and that para said that whatever rectification in the returns or whatever omissions have happened in the subsequent in the previous returns, it can be done in the subsequent returns only. So Bharti Airtel had a point by saying if the system of GSTR 123 was in place, this error would not have happened. They would have been able to see the credit in their GSTR 2A, which was otherwise coming. They would have claimed it, and they would not have paid the cash of 937 CR. Now they've already paid it, And the ITC they have taken subsequently, they want the cash back, and they want the credit which was otherwise available to them to be used for payment of tax. This looks like a little complicated thing which was being asked, but Delhi High Court was basically impressed by the manner in which it was put forth, and the Delhi High Court agreed that they are reading down the specific para 4 of circular number 26, and they said that yes, refund should be granted, so the refund was granted. Department went into appeal in the Honorable Supreme Court. Honorable Supreme Court again read the matter, and they said only two important things out of this, though the judgment came against the SSC. First thing which they said is, you see there is section 39 subsection 9, which clearly talks about the mechanism how an error and omission needs to be taken, or rectification needs to be taken care in GST returns. So Delhi High Court said, first of all, we are not being asked whether GSTR 3B is a return under section 39 or not. We are not being asked whether GSTR 3B is a return under rule 61 or not. Delhi High Court said, as of now, how we read the rules, we understand GSTR 3B is a return under section 39. Honorable Supreme Court said. Second thing Honorable Supreme Court said is, once it is a return under section 39, second thing to understand is 39.9 is a specific provision which says how rectifications would be taken care of. And it talks about that it will be taken care of in the return subsequently with an outer date of the September up to next year. Once there is a section in place, one can't go beyond that section and give an understanding by saying that yes, cash refund should be made available to the SSC, and hence that cash refund which was allowed by Delhi High Court, it was quashed. The circular 26 was kept in place. Now that's the judgment. We look at it, we realize it's a negative judgment, but this judgment has a lot of positives, and two three positives which are very important for us to understand, which probably can be helpful for us in other matters in all of us which are arguing. And the first matter which Honorable Supreme Court said is that when you talk about the credits which were taken by people in the month of July, August, September, October 2017, Honorable Supreme Court said just before July 17, maybe a matter of what, 2 to 3 months, 4 months before, how were you taking the credits? And that's written in the judgment of the Honorable Supreme Court. And the Honorable Supreme Court said at that point of time there was no GSTR 2A. The credits were taken on the basis of, first they were recorded in the books of account. Once it was recorded in the books of account, and subsequently it was taken in the GST returns. Now, if that process was being followed, what changed comprehensively from 1st July 2017 to say that only credits which are appearing in GSTR 2A would be the basis of taking the input tax credit? And on this basis, the plea of Bharti Airtel was basically negated to that extent. Now, if we take this in our case, all those cases where department is saying if credit is not appearing in your GSTR 2A, you can't claim it. Probably this aspect which has been taken care by the Honorable Supreme Court, we can reproduce that, we can rephrase that, we can apply that analogy and tell to the concerned officer that the Supreme Court has said is till the time the law does not say that, or at least the mother provision does not say the credit should appear in your GSTR 2A, you can't force a particular assessee to say that he's not entitled for the input tax credit. And that's the one point which comes out quite clearly from this. And that brings me to the next interesting issue, that issue which I'm sure every speaker deliberates upon when he speaks on input tax credit. I don't want to talk about other aspects. I only want to talk about two judgments in respect of this, not directly on GSTR 2A, but it gives reference to GSTR 2A and 3B differences, and they are helpful for us for our understanding. So one is this Bharti Airtel judgment, Honorable Supreme Court. It clearly said that GSTR 2A is only a facilitator for taking an informed decision while doing self-assessment. Non-operability of the same does not deprive the assessee of any benefit. That means it only helps, it is only for aiding the assessee, but it can't be a basis for taking your self-assessed input tax credit. And I think that should be one of our premise of while we are writing back to the officers wherever they are being issued notices for difference in credit between GSTR 2 and GSTR 3B. Come to another judgment from the Honorable High Court of Jharkhand, where somebody was issued a show cause notice under section 74 for difference in input tax credit. as appearing in GSTR 3B and as appearing in GSTR 2A. And there, the NKS Services Private Limited, the Honorable Jharkhand High Court has said is that, see, one thing to understand is if the difference is there in your credit in GSTR 2 and GSTR 3B, it cannot be sole basis for levying the charges of suppression and or willful suppression upon an assessee. That means a show call notice cannot be issued under Section 74 if the credit, there is a difference in input tax credit as appearing in returns and as appearing in GSTR 2A, because both figures are in front of department is already aware of it. Department is aware what is there in GSTR 3B. Department is aware whatever is there in GSTR 2A. Department cannot allege upon the assessee that assessee has willfully suppressed anything. In fact, department knows that there is a difference, and that is why they're coming to the assessee and asking the question. So two things from this: one, 2A 3B difference notice cannot be there under Section 74. Number two, Bharti Airtel Honorable Supreme Court, they have said that GSTR 2A is only a facilitator, but it cannot be a basis for taking the self-assessed input tax credit. And then you bring that the amendment which is going to come in Section 2 AA, which is going to come. It is still not, the date of it has not been notified yet. Once it is going to be notified, you read that with Bharti Airtel, and now that's what the Honorable Supreme Court has said, that till the time the provision is not there in the law, it is only there to help you. Now once that provision would be there in the law, then department has a good case to argue that now credit should appear in GSTR 2A if one wants to claim it, because that becomes one of the important conditions for taking the credit. But till that time, there is no problem. Now come to another issues with people who do a lot of compliance work. They face it on daily basis. Like for example, this advisory which was issued somewhere on 17th of October 2021 in respect of input tax credit by GSTIN. Now, mind you, friends, this advisory was not issued by CBIC. This advisory was not issued by GST Council. In fact, it did not come from any commissioner of any specific jurisdiction. It came from GSTIN, where GSTIN advised that if somebody is filing a late return for the month of September 2021, then all the invoices in respect of 2021, the system will write or give will give a remark that ITC is not available in respect of it in GSTR 2B. Now, people got panicked. People realized that there is some amendment in law which has taken place, that if I am the supplier and you are the recipient, and as a supplier, I am filing my September return late beyond the due date, then as a recipient, you will not get input tax credit because I have filed my GSTR 1 after the date, after the 11th of the October. And then the question came up that what is the locus standi of this advisory? What is the basis of this advisory? What is the authority of this advisory? And I think the legal answer to all of this is that advisory issued by GSTIN is not binding on anybody. In fact, as a matter of advisory, also this advisory has no influential value on any of the officers of GST, any of the assessee, or in fact any tax practitioner or taxpayer. Whatever comes under the provisions of the law, circular issued under Section 168, notification issued under the law, or rules made under the law, or any change in the law or any provision of the law, that only binds and tells whether input tax can be claimed or input tax credit cannot be claimed, or whether it will be available or it will not be available. So advisory of this sort, basically one should not get influenced by this, rather one should read the provisions of the law. In fact, when you read the provisions of the law, one question which generally comes up is, what is this GSTR 2B? And should I actually take credit on the basis of 2A or 2B? And again, answer to this, rather going into a lot of ambiguity that 2B is for this and 2A is for this, you look at the 45th GST Council meeting minutes, which were not minutes rather, but the press release which was issued. And when you read the press release, you realize on the reading of press release, they have referred to Section 16.2 AA, which has, again, as I said earlier, has not been notified. It is going to be notified. And there in that press release, they said that once it is going to be notified, the 100% matching of input tax credit will be done. And then they've also specifically mentioned that once it is going to be notified, then the matching will be done on the basis of GSTR 2B. And this again kind of gives you that indication that the difference of GSTR 2A 2B. Some officer doing on the basis of 2A, some officer doing on the basis of GSTR 2B, some officer doing on the basis of third thing, any other thing. That clearly again is variety of practices. When you read the provisions of the law, or in fact rules made there and somebody religiously wants to follow rule 36 sub rule 4, rule 36 sub rule 4 does not talk about GSTR 2A or GSTR 2B. Rather, it talks about whether supplier has shown his outward supplies in respect of the recipient in his GSTR 1. And as a recipient, if I am able to demonstrate that my supplier has shown the supplies in GSTR 1, I am very well entitled to take my input tax credit as per Rule 36 sub Rule 4, and reflection in 2A, 2B actually makes no difference. Department may issue a notice to which we cannot deny, but we should be ready to give an answer to it on the basis of what we see coming out from the council, what we see on the basis of the circulars or notification issued in this regard. Come to another very interesting issue, that issue which has now gained a lot of traction, that issue which has now been raised by department at various forums, that is reversal of input tax credit. And what example has been taken by or in fact the basis which have been generally taken around in respect of exporters. So all the exporters generally who export goods, before this ROETP came into place, they were getting this MEIS and ACIS licenses. And from this MEIS and ACIS licenses, basically, they were able to sell them in the market or use them for the purpose of their imports and saving their import duties. Now, all of us know that all these MEIS and ACIS licenses are treated as goods, and the rate of GST from October 2017 on them is nil. Now the problem is what basically GST department is contesting is to all the exporters. Let's say I am an exporter having a turnover of 100 crore rupees and I have sold a license of let's say 4 crore rupees in this year. Then the departmental officer would tell me that all the inputs which I have used in manufacture of the goods which I have exported, in that case the I have used the total credit for manufacture of those exported goods, for the sale of goods which I've exported, and for the sale of license. Because the logic given by them is, if I don't export goods, I would not be able to sell this MEIS license. And if I don't buy raw material, if I don't manufacture goods out of this MEIS license would not have come into picture. And that is why they're saying all my credit becomes my input, common input credit. And if I have a total credit of let's say 10 crore rupees, then out of 10 crore rupees, I should reverse 4% of it. That is 4% is my sale of exempted goods. So I should reverse 4% of my 10 crore rupees. That is approximately 40 lakh rupees I should reverse out of my credit. And I think there the concept which is very important to understand is that what tantamounts to common credit, how one needs to identify that, and how reversal of it that needs to be done. And again, I think in this respect, we will have to go back to the earlier laws to understand basically whether all the outward supplies which are happening, which are exempted, can I attribute my credit towards it? Should I attribute it or should I not attribute it? For that, again, one is to understand first that all these MEIS licenses or SEIS licenses which are being sold, they come into existence only when the export has taken place. So that does not mean that I am able to sell all these exempted licenses because I'm actually selling the exported goods. I'm able to sell MEIS licenses because license gets birth only when I take the export, and then I don't want to use the license for the import. That is why I'm selling it. Rule 42 or Section 17 subsection 2, which talks about reversal of input tax credit, it talks about very specific thing. It talks about input tax credit which I have used for outward supply of exports or taxable goods and outward supply of my exempted goods. Now, for outward supply of exempted goods of these MEIS license, I have not used the credit of the raw material which I have purchased for manufacture of exported goods. Because as I said, all these are MEIS licenses, they arise only when I do my exports. Till the time I don't do my exports, these MEIS license would not come into place or they would not come into existence at all. And for this, we can take reference from the old excise regime where they talked about byproduct, where somebody is manufacturing excisable goods, some byproducts are getting generated, and then if those byproducts are not excisable or not leviable to excise duty, the question which came up was any SENVAT credit needs to be basically reversed in respect of them or not. And there we had rule 6. And there in that rule 6 of Sanvad credit rules, there was a judgment. One of the judgments of Ahmedabad tribunal is Gujarat Mineral Development Corporation lignite project, where it was said that byproduct ultimately no Sanvad is attributable to manufacture of it, of this byproduct, and that is why no Sanvad credit is required to be reversed. I think same concept we can borrow in GST, and we can look at whether any reversal is required to be done or not. I would skip this ocean trade. I will come to this royalty on 2-3 issues before we open up for question answer session. I think this royalty issue has gained a lot of, again, I would say, center stage in last 3 months or so, where a lot of people have been issued notices in GST regime and also in the service tax regime. And interestingly, out of this 45th GST Council meeting, some circular has also been issued where the applicability of rate of GST on this royalty has also been clarified. Now, before we go to the rate, friends, it is very important to bring out here for the benefit of all the members that this royalty which we are talking about is the royalty paid to the state government by all those people who are doing mining or various type of minerals which are there beneath the earth. And when they want to do the mining, they have to take a mining lease from the state government. When they take a mining lease, they commit to the state government that they will pay a specific royalty on the basis of the amount of minerals extracted. And if that is going to be lesser by some standard, then they will pay a minimum dead rent to the state government. The question is whether all this royalty or dead rent which is being paid to the state government, is it a supply of service by the state government to all these mining leaseholders? And if it is a supply of service, then the provision of reverse charge mechanism says that service supplied by the government to a business entity is under reverse charge, and that is why all these mining leaseholders have to pay tax under reverse charge. Today, the matter is pending before the Honorable Supreme Court in case of service tax and also in case of GST. In case of GST, we have a matter pending in Honorable Supreme Court in case of Lakhinder Singh, where a stay has been granted. And in case of service tax, we have a matter in Udaipur Chamber of Commerce, where again stay has been granted on the recovery proceedings. Supreme Court has to hear the matter whether service tax is leviable and GST is leviable or not. The main point of contention is whether this royalty and a dead rent, whether it is a service, whether it is a tax, or whether it is any kind of privilege given by the state government to all these mining holders. If at all it is a service, then only the question of applicable rate of tax will come. Now, what has happened is in case of this royalty, at least in case of service tax, department has issued notices in last 1 month or so for financial year 16-17, because this concept of reverse charge in respect of services by government to business entities in context of service tax came from April 2016 only, and they've issued notices by saying that all these people who have not paid tax on royalty, they have deliberately not paid the tax, and extended period has been invoked. That is, the notices have been issued beyond the period of normal period. Just like we have section 74 under GST, we have proviso to section 73(1) under Finance Act 1994. First thing to understand, a matter which is already pending before Supreme Court, a matter which is pending in almost 10-11 high courts. It cannot be a case of suppression. It is a case of confusion. It is a case of bona fide understanding that service tax is not applicable, and all the show cause notices issued by invoking extended period, they cannot stand. Come to GST, notices have been issued. One has to argue in case they have not paid the tax. Another interesting issue is, if let's say I want to pay the tax, I don't want to go into that issue whether it is taxable, not taxable. The second issue is what is going to be the rate of tax. Now, in this regard also, we have HSN code 9972 and 9973. Both of them are very interesting to read. If you will read 9973 HSN code, you realize there were a lot of changes in that HSN code, rate of tax. For up till 31st of December 2018, there was no rate of 18% in that HSN code 9973. And this mining royalty, if at all it is a service, it falls under this HSN code 997337. That's what in fact government has also agreed to. They have mentioned that in the circular also, which you can see on your screen. So up till 31st of December 2018, there was no rate of 18%. What was the rate? The rate was rate as applicable on the underlying goods against which this royalty is being paid. So if this royalty is paid in respect of minerals, all minerals, they are taxable at the rate of 5%. So that is why there were advance ruling which said that if in case there is any GST applicable on royalty up till 31st of December 2018, it is applicable at the rate of 5%. However, government realized that probably this will lead to some revenue leakage, and on 17th of September 2021 they came out with a circular by saying that we always intended to charge tax at the rate of 18% on royalty. So even for the period up till 31st of December 2018, though the HSN 997337 does not have a rate of 18%, still it should be taxable at the rate of 18%. And when you read it, you realize that it is kind of funny. It is kind of in the manner in which it is written, it talks about the intent, but all of us understand when you're reading the law, before reaching to the intent, you have to go to the actual words. When the words are unambiguous, when the words are clear, when there was no rate of 18%, government cannot force anybody to pay tax at the rate of 18% from 1/7/17 to 31/12/2018. After 31/12/2018 on royalty again, it is another dispute whether it is applicable at the rate of 5% or 18%. Government has a better case to argue after 31/12/2018 to say it is applicable at the rate of 18%. But there are good cases, but there are good grounds to argue that still, even after that, it should be taxable at the rate of 5%. So what I'm trying to say is, tax on royalty, it is matter pending in Supreme Court. Let Supreme Court decide that. If by chance Supreme Court decide that it is taxable, the next issue which is going to come is regarding the classification. All those who are into this mining business, they should keep a watch on this. If they can pay that tax under reverse charge, they should actually pay tax under reverse charge, hold it, and decide whether they want to file a refund claim for it, or they want to claim the input tax credit. Why I'm saying a refund claim? Because time limit for filing a refund is only 2 years from the date of payment of tax. So if somebody wants to comply with it, but they see a possibility that they would not be able to use input tax credit, they should pay tax and claim a refund out of it. Then we come to second last issue, very interesting issue for the purpose of understanding, though it may not actually help you directly in your day-to-day practice, but again it will help you to understand how government or any specific a person at the other side would read the law or would look at it. And again, it's a matter of interpretation which has come out. So we have ice cream parlors and we have cloud kitchen. We have a circular which came in respect of this what is the applicable rate of tax and classification of goods supplied by the cloud kitchen and the ice cream supplied by the ice cream parlor. Now, cloud kitchen as a concept, we all of know, is a place which does not have a place for sitting. It's a purely kitchen. They would list themselves on various e-portals or the food portals where people will order. This kitchen would prepare food and give it to this online portal, and that online portal will deliver to the respective customer. Where on ice cream parlor, you will go to a parlor, it will have a sitting space, it will have air conditioner, it will have some ambience, some music, and then you will look at the menu and it will choose, and then you will get your choice of ice cream. Both of them asked a question that what should be their applicable rate of tax, what is the classification, whether they are supply goods or supply services. Now, what council said important thing to understand classification in respect of food items is whether there is a kitchen or not. And the answer which came out is, in case of cloud kitchen, because they have their own kitchen, so it becomes a restaurant service taxable at the rate of 5% without ITC. And in case of ice cream parlors, because they do not have a kitchen, they have a pre-prepared ice cream lying in the freezers where they only make different scoops and customize it. They're only selling goods, so they're pure supply of ice cream parlor, supplying ice cream, which is goods, taxable at the rate of what is applicable on supply of ice cream with whole input tax credit available. When you read both of them together, you realize that government is thinking from the point of view of whether there is a kitchen available or not. However, when you look at it from the recipient's perspective, a customer's perspective, Probably kitchen would not be the primary factor on the basis of you will decide whether you have availed a restaurant service or you've actually bought a food. Because now with this, when you buy ice cream at a shop, the rate of tax will be different. When you take a ice cream in a hotel room where you have ordered in a hotel room, the rate of tax will be different. If you take ice cream in a five-star restaurant, the rate of tax will be different. And when you actually go and take ice cream at an ice cream parlor, the rate of tax is going to be different. So that is going to have kind of some interesting challenges thrown up, but that's how one would look at it. Finally, before I end, I think two things, two judgment which I would like to compare and bring before all the participants, again for the purpose of understanding. One judgment I think all of us are aware of, Honorable Supreme Court in case of VKC Foot Care, where they have said that under inverted duty structure, one cannot claim refund of ITC which one has paid in respect of input services, because when you look at the formula for refund under inverted duty structure, under it rule 89 sub rule 5, it does not talk about giving refund of the ITC paid on input services. So that has kind of bring a lot of clarity. May not be a favorable judgment to the assessee, but again brings definitive clarity, and one may plan their affairs accordingly. Come to right hand side of the judgment, very interesting judgment from Guwahati High Court in case of BMG Informatics Private Limited, where in this case somebody was basically into trading of goods. They bought some goods at a higher rate. Subsequently, the rate of tax was reduced on the same goods only, and then that person actually went on to claim refund under inverted duty structure. When they went on to claim refund under inverted duty structure, the officer said that there is a circular number 135 which says that in case somebody is doing trading of goods, they cannot claim refund under inverted duty structure, because that's the same goods in which somebody is dealing, where they have a higher rate of tax on the same product, but due to rate change, the rate has reduced subsequently. The Honorable High Court said that a circular which says that refund under inverted duty structure cannot be claimed by a trader, that is not coming from the provisions of the law, and a circular cannot go beyond the provision of the law or rules made thereunder. Now, this being the case, this kind of opens up arena for all those people who have a lot of input tax credit available with them, who have some inward supplies at a higher rate. Their main item is at a rate which may be at the 12% or 5%. They have a lot of accumulated input tax credit for maybe variety of reasons. On the basis of this BMG informatics, they may consider claiming a refund under inverted duty structure in spite of doing trading, in spite of having their majority products on the one single rate, but having some products at a higher rate. So on this basis, when you look at it, right hand side, High Court gives you one option available where one may claim a refund, even if being a trader, whereas Supreme Court gives a clear definitive answer to it, that at least refund under input services cannot be claimed under inverted duty structure. I think with this some 10-15 issues I wanted to bring before all the members in this given limited time, so that we may look at various provisions, we may look at various things which are happening around, and we may decide that whether we want to have clarity or we want to go into litigation. Because I would end from where I started, that now when you want to go into litigation, you have to be absolutely clear that the 10% that you're shelling out is from your cash ledger but not from your credit ledger. I would like to thank again CA Sansaar family for giving me this wonderful opportunity. And back to you, Prachiji, in case we have any questions. Thank you so much.
Right now, we don't have any query yet. To all the viewers, if there's any query, please post in the comment section.
I think we can go ahead and close then.
Okay, sir. So thank you, CA Yash for giving your valuable time to us and adding up to this webinar MahaKumbh series. It was a great session and you shared your knowledge on the core session of yours. So thank you so much for being here. Thank you, sir.
Thank you so much. Thank you.